Hello, in this video we'll continue with our discussion of the taxation of partnership allocations. This is the second part in a three-part series. If you have yet to watch the first video, the first part of the allocations, which deals with the introduction to partnership allocations and substantial economic effect, I strongly recommend that you look at that video first because many of the concepts in this second part will be needed from that video to understand the idea. So if you recall, from that first part when we talked about substantial economic effect and partnership allocations in general. We're talking about allocations of partnership items, income, loss, deductions, credits, and whatnot, not distributions. Those two are different terms. Allocations are each year, even though the partner might not actually get the actual cash or whatnot from the partnership. If it's made money, the partners are going to be allocated a certain amount of income, losses, whatnot, just like it's on paper. Well, we talked about in section 704A that generally speaking, a partnership allocation will be respected when you're looking at the partnership agreement. This goes back to the whole idea of how Congress, when subchapter K was originally drafted back in the 1954 Internal Revenue Code, the main overarching theme was flexibility so that taxpayers could have a way to conduct business, and from a tax policy standpoint, there was no efficiency issues with respect to, okay, well, certain transactions, are they going to affect certain behavior? All right, that's just a short and simple way because it's a lot more complex than that. But that's really the premise. So there's a lot of flexibility in the partnership area. So that section in 704 says we look at the partnership agreement, but that's in 704A. However, the allocations will be respected in the partnership agreement in 704B if it has substantial economic effect. Which, remember, the general idea of substantial economic effect is that if a partner is allocated a specific item, a specific tax deduction, then that same person who bears the economic burden or the tax burden must also bear the economic burden. When you're looking at substantial economic effect, it's all about, does the tax equal the economics or the econ? The economics. They must equal. So the tax allocation must be the same as the economically, what actually is happening economically. That's the key. And we talked about the general ideas in that first part of the video and how there's safe harbors and there's partners' interest in the partnership and how the allocation will take place. So please, if you have not yet looked at that portion, you need to consider that. Now remember, if from that video, I mentioned that there's some special rules dealing with non-recourse liabilities, allocations related non-recourse liabilities, and also book-to-tax disparities. Because what you're going to see, and in this part, we're going to talk about the allocations related to non-recourse liabilities. What you're going to see is that the substantial economic effect rules generally do not work, and I'll explain why in this presentation. Same thing with book-to-tax disparity, which will be part 3 of the series. So again, I want to harp on the whole idea when it comes to, and I already said this, the whole idea of allocations, Congress wanted to keep it as flexible as possible. And again, if the partnership agreement says one thing, that's fine, but the economics has to be respected. So the principle on which all partnership allocations are based is that tax deductions must be allocated to the person who bears the economic burden associated with those deductions. Let me say that again. And I want you to write this down if you're taking notes. The overall principle on which all partnership allocations are based is that tax deductions must be allocated to the person who bears the economic burden associated with those deductions. That alone is a huge part. That alone is a huge part. Okay, and that goes to this premise right here. So make sure, again, that you take note of that, write that down. All right, so we're talking about non-recourse liabilities. So the next thing I want to talk about is the distinction between recourse liability versus non-recourse liabilities, which some of you out there may already know the distinction, but others may not, so we're going to talk about it. So to keep it as simple as possible, it actually gets a little bit more complicated, but think about the different types of business entities out there, okay? Whenever I explain recourse and non-recourse liabilities, I always tell the audience, think about it when you're talking about different types of business entities, where you have general partnerships, limited liability companies, corporations, proprietorships, all the different types of business entities. I'm sure that you probably have heard that certain types of business entities have limited liability, meaning that the owner is not expected to go beyond what the owner's invested in the case where the business goes belly up, goes bankrupt, or whatnot. And there's obviously some small exceptions to that, but that's the general idea. In certain business entities, that's true, like a corporation, limited liability company, some partners in a limited partnership, or all partners in a limited liability partnership, whatnot. But others have unlimited liability, a general partnership. General partners have unlimited liability. Now, recourse versus non-recourse liabilities is not exactly the same distinction, but it's the overall same idea. If a business or a person takes on a recourse liability, then the business or the person is saying that the property itself, the loan, they are going to personally guarantee the loan, meaning that they're going to have to pay that loan back regardless what happens to the property, whether the property goes down in value, whether it goes up in value. Recourse, the lender, it basically has insurance that the party must pay back what's owed. And if they don't, then they can bring a legal action against that party. Non-recourse, though, is that limited liability idea where the property is going to be limited to, and it's usually secured by the property itself, the collateral. That's usually. Non-recourse liabilities, usually, and they're becoming more rare and rare as the financial environment becomes more and more risky, but non-recourse liability, usually the property itself is attached. So if you borrow money, let's say, and you buy a house for $1 million, and you borrow that $1 million on a non-recourse basis, and you attach the property, okay, you're probably not going to be able to get this, but the property is going to attach to the actual mortgage, okay? Now, if it's non-recourse and the value of the property goes down, goes underwater, so let's say the value of the property when you bought it, it was $1 million. Let's say the next 2 years it goes up to 1.2, but then the market crashes. Let's say it goes down to $800,000. Well, if it's not recourse, you're probably just going to default on the loan. Okay, let's say you haven't paid anything back yet. You're going to default on the loan because guess what? That property is only worth $800,000, but you're still, if it was recourse, responsible for paying $1 million. Non-recourse, that's not the case. So why pay $1 million for something only worth $800,000? So you'd rather walk away. Now, there's all sorts of reasons why you would, like keeping credit and all sorts of other things, to worry about. But we're just saying from an economic standpoint. So you basically assign over the property to the lender, and now the lender basically bears the risk. So the idea is that with a non-recourse liability, the lender ultimately bears the risk when it comes to situations with respect to the property going underwater, going down in value. That's going to be key in understanding the allocations related non-recourse liabilities. Because as I said, again, I'll say it again, the underlying principle on which all partnership allocations are based is that the tax deductions must be allocated to the person who bears the economic burden with respect to that item, the risk. So we can think of that like risk, the economic burden, the risk of that item. Well, in a non-recourse liability, the lender bears the risk. As we saw in our example, where the value of the property went down to $800,000, and the borrower just decided to default because they're not going to pay back $1 million for a value worth $800,000. So now the lender is the one that bears the risk. That's key because we can't apply our normal substantial economic effect rules. It doesn't work because the lender is the one that bears the risk. The lender. So the question becomes, does the lender get to be allocated these deductions? These non-recourse deductions that we're going to talk about, or certain deductions? And the answer to that is no. And the reason the answer to that is no is because the Supreme Court in Crane v. Commissioner, so first the Supreme Court in Crane v. Commissioner, which that case came back in the 1930s, 1940s, and then again in Tufts versus Commissioner, which was in the 1970s, 1980s. I say 30s and 40s because this is based on, the facts of the case and when the case was actually heard. It went through all the way to the U.S. Supreme Court. And then finally the regs, which basically reaffirmed Crane and Tufts. In that case, in those cases, or that line of law, I should say, the Supreme Court and the regulations, they say that when property is purchased with the proceeds of a non-recourse, which we just talked about, a non-recourse, NR, a non-recourse debt, non-recourse mortgage or non-recourse debt, the purchaser is the sole owner of the property. So the purchaser owns the property. The purchaser owns the property and is the only one, is the only party that can be allocated deductions, like depreciation or other types of cost recovery deductions, that can receive deductions related to that property. So the lender, it's not possible. The lender cannot receive deductions under that area of law. So that creates a big wrench in this. Well, if we can't allocate, again, going back to the previous slide, if we can't allocate using the general principle of allocations, which again, I'll say it again, I know I've said it before, is that the tax deductions must be allocated to the person who bears the economic burden. Well, that person here is the lender for a non-recourse loan. Well, if we can't allocate them to the lender, well, who are we going to allocate them to? Well, under the case law, the only person that can get the deductions is the owner of the property, which you're going to see in our situation is going to be the partnership, because in our situation, or the limited liability company, or whatever it is, that we're applying the partnership rules, because that is the party that's going to be taking on buying the property with non-recourse financing. So in addition, Tufts, Crane, and the regs say acquisition debt is included in the basis of property. So you get to include the non-recourse liability when you're calculating the debt to take depreciation and whatnot. The basis attributable to the debt may be depreciated, which is the idea I said, and it has to be taken by the owner. And the sales proceeds include the amount of the non-recourse note transferred or relieved, which that's if you default. And I'll explain that more. So the idea is that in the example we talked about, right? So let me put the facts of our example, right? We bought a house for $1 million. And that was the value of the house. So $1 million house, and it was a non-recourse mortgage or liability, right? Let's say 3 years later, the market tanks, and now, so we'll say this is in year 1. In year 3, the house is now worth $800,000, and the mortgage is still $1 million. So $800,000 fair market value, and the mortgage is still $1 million. So the lender, guess what? The lender, when we default, we don't pay, we go into foreclosure, the lender ultimately bears the risk, because again, it's non-recourse. We're not responsible for going beyond what we've initially invested, right? So the lender actually bears the risk of that. That's that $200,000. The full amount of the non-recourse mortgage, this full amount goes into the amount realized. Goes into the amount realized when we put that into foreclosure. So the basis of our property, right? We take amount realized minus adjusted basis, and if we depreciated that property down, let's say that wasn't a house, but it was a building that we used in business, then you're going to see there's going to be a gain. There's going to be gain. And now we call that Tufts gain. Tufts gain. Now, there's some examples that, that I recommend doing, and if you're not taking one of my courses, you're not going along with my materials, then I recommend looking into a partnership book or with examples and going through the examples in this area, because it's very helpful to understand this idea looking at examples. It really comes down to the numbers. It really comes down to numbers. So let's look at an example in the partnership context. So let's say we form a partnership. General partner, it's a limited partnership. General partner contributes $10 and limited partner contributes $90 of cash. In addition, so right now from there, the partnership has, the limited partnership has $100. Partnership borrows $900 on a non-recourse basis to acquire real property. Now the partnership's going to pay $1,000. That's the so the $1,000 amount is the 100 cash and the 900 non-recourse financing. Now the property is depreciable over 20 years for $50 per year. So that's going to be important, $50 per year. So we allocate the depreciation 10% to GP, 90% to LP. That is in the partnership agreement. That is what the partnership agreement says. So the question becomes, will this allocation be respected? So again, I recommend if you have not done so, go back and watch the first video. Because the first thing you want to do is you want to look at substantial economic effect. We go through the three things. Let's say that we don't meet the basic test because, again, we have a limited partner here. So we can't meet the basic test, let's just say, because the limited partner is not expected to go beyond any amount. They're not expected to go beyond or have a negative capital account balance. However, the alternate test, let's say, is met. If the alternate test is met, then in the first 2 years, the allocation, the $50 allocation in year 1 and 2, will be respected under the safe harbor. So it will have substantial economic effect. The 10% to GP, 90% to LP. So after 2 years, this is what the picture looks like. Here, take a look at this. We have the realty that we purchased, the depreciation taken $50 per year for 2 years, which gives a book value of $900. Also a basis of $900 as well. Also a basis. And a basis, adjusted basis. The debt is $900, which is the non-recourse liability, right? The capital accounts, G has gone down to 0, L has gone down to 0. So at this point, whenever you have non-recourse financing and you're looking at allocations related to them, you want to compare the liability amount, which here is the $900, and you want to subtract away the basis or book value. The adjusted basis, book value. Which usually it's the basis we consider if there's differences. But for this example, it's the same, which is also 900. That gives us 0. If this number is positive, then guess what? Substantial economic effect will not work. If this is a positive number, then substantial economic effect will not work. You can't use that. You got to use a different set of regs. You got to use Reg 1.704-2 set of regs. Remember, substantial economic effect is Reg 1.704-1. Okay? If this number is 0 or negative, though, we do use substantial economic effect, which is what we have here. Well, what happens in the third year? In the third year, after the end of the third year, the non-recourse financing stays at $900. By the way, assume in this example that it's a balloon payment, that the partnership is not expected to pay back any principal of the $900 until the end. I know it sounds a little ridiculous, but just assume. After the end of year 3, it's at the end of year 3, the non-recourse financing is still $900, but the book value goes down to $850 because we have $50 more dollars, right? So we have $50 in year 1, $50 in year 2, $50 in year 3. So that's $150. So that makes our book value, right? 1,000 minus $150 is $850. So now we have a positive 50. Guess what? This 50, you can't do substantial economic effect. So the question becomes, how do we allocate this 50? Are we going to use the same rule we did for the other? Do we need to use something else? That's what this discussion is about. That's really what this discussion is about. Okay? So, by the way, it's possible that when you're looking at these rules, Reg 1.704-2, for the non-recourse deductions, the early years you could have substantial economic effect, just like we saw in this example, and the later years you have to apply the non-recourse deduction regs. So that's important to understand because if you remember, when we talked about the basic and alternate tests in the first part, the first video, remember the basic test was all or nothing? The alternate test, though, You could have one result in 1 year and a different result in the next year. So basic test was all or nothing, alternate test was not. The non-recourse deduction substantial economic effect test is similar to the alternate test. We can have one result 1 year and then another result the next year. You have to look at every year independently. You do. It's very important. All right? So let's take a look at what exactly is needed for non-recourse deduction. So again, a 1.704-2. So just for now, consider non-recourse deductions to be any cost recovery deductions, and it's actually a little bit more than this, and I'll explain later on. But for right now, the simple explanation of non-recourse deductions are any deductions that are related to non-recourse financing that are cost recovery beyond the substantial economic effect principle we saw earlier. So beyond when that non-recourse financing becomes greater than the adjusted basis. That's a non-recourse deduction. That's the simple test for determining it. It's a little bit more complicated. I'll explain later how, but usually that's how you determine it. All right? So just like we had safe harbors for the substantial economic effect test, we also have the same for non-recourse deductions. And that's found, this is a safe harbor, that's found in Reg 1.704-2E. It's a 4-part test. 4 parts. You need all 4. Now, number 1 and number 4 come from the substantial economic effect reg. So that's why you need to go back to part 1. I know I've said that now 5-6 times. You got to go back and do part 1 before you look at this stuff. It all relates. So in order to get the safe harbor, you have to go through the substantial economic effect analysis first. So number 1 says you have to meet either the basic or alternate test for substantial economic effect. Please see the previous discussion. If you remember that, the basic test, we had to have capital counts. If you liquidated the partnership, it must be in accordance with capital account balances. And then finally, that all partners must contribute money back to the partnership if they have a deficit. So limited partnership, it's not going to happen because the limited partner can't go negative under state law. However, the alternate tests, capital accounts, right? So must follow capital accounts, must have the capital accounting according to the regs in 1.704-1. In addition, you have to have a qualified income offset, right? And that's really the part to harp on, qualified income offset for the alternate. And finally, the last one for the alternate test is that when you're looking at the partners, you can't go negative beyond what a certain partner is expected to actually go if the partnership does go negative upon in liquidation. So usually for a limited partner, that's 0 because they're not expected to go beyond their investment. All right. So number 4 also deals with the capital accounting. So number 4 is just simply capital accounting, which if you meet number 1, you meet number 4. It's the same. It's part of the same steps, the capital accounting requirements in Reg 1.704-1. All right, you have to follow that. Number 2 and number 3 are the new parts added in for non-recourse. So number 2, students have a little trouble with number 2, and I will explain that I'll explain that right after I read this. So non-recourse deductions are allocated in a manner reasonably consistent with other allocations having substantial economic effect or attributable to property securing non-recourse debt. So what that means is that the non-recourse deduction, let's say in the partnership agreement that specify what the non-recourse deduction will be. That non-recourse deduction must fall in a range. It must fall in a range of possibilities that other items are allocated. So, for example, if you look at a specific partnership, and let's say that the non-recourse deductions are supposed to be allocated 50-50, but all other items of income deduction loss other than non-recourse deductions will be allocated 90% to, let's say, a limited partner and 10% to the general partner until the first time that income and gain exceed losses taken in prior years. Once those income and gains exceed losses taken in prior years, which simply just means that if you look at all the years of the partnership, once a profit has been established. Once the profit has been established, then it will go from 90-10 to 50-50. So that range, you have to look at each partner. In our example, it was L, could be between 90% and 50%. 90%, generally speaking, that's what the non-recourse deductions, items other than non-recourse deductions will be allocated. But when it switches over to profits, it'll be 50. So it could be anywhere from 90, so greater than or equal to 90. Greater than or less than. That's less than. So between 90 and 50. It can be 50, it can be 90, it can be anything in between for L. For G, it's anywhere from 10 to 50. 10 to 50. Based on the range of deductions. So you have to have if you're going to have a range, you need at least two. So to have the range, you need two items other than two allocations in the agreement other than the NRD provision. Other than the NRD provision. You can't use the NRD provision when you're looking at, the actual, whether this will meet the safe harbor. And finally, number 3, the partnership agreement must have a minimum gain chargeback, and that is the heart. That is the heart of the non-recourse deduction safe harbor. That there must be a minimum gain chargeback provision in there. Now, minimum gain chargeback is different from qualified income offset, and I'll explain in a little bit, but I want to harp on that this is very important. This is extremely important, having this minimum gain chargeback. And the reason is because Congress, again, wants to keep in mind the flexibility concern of subchapter K of the partnership rules. Congress basically says, okay, we understand that when you go back to Tufts, Crane, and the regulations, the purchaser is the only one that can get the benefit of the deduction. The lender cannot. The lender cannot, even though the lender bears the risk. So the Congress, when they're drafting these rules, says we're going to allow extreme flexibility. So there's extreme flexibility here. The NRD rules are extremely flexible. Allow for a lot of flexibility. Extremely flexible. Very important. These rules are extremely flexible. However, there is a strict sense as well. The idea is that if you remember back to the your federal income tax course, you might have learned about the no double tax benefit provision. Or I shouldn't say provision, common law idea, which is all over the Internal Revenue Code. You can you get tax exempt income for certain things, but you can't take a deduction for other things. For example, municipal bonds, right? Recall that whenever you invest in municipal bonds, the interest that you earn off municipal bonds is tax exempt. Now, if you borrow money to buy the municipal bonds, and you have to pay interest to that borrower, and you're arguing, okay, that's investment interest, you can't deduct it because it's related to a tax exempt item. Okay? Well, that idea is a no double tax benefit principle. It says that, okay, you can't have your cake and eat it too. You can't get both. That's the same thing here. Basically, Congress is saying we're going to allow you extreme flexibility. However, when it comes to certain events later on, you're going to have to strictly follow our rules. And that's what the partnership minimum gain provisions are all about, or the Tufts gain. So basically, we're going to have this idea called partnership minimum gain, which is also known as Tufts gain. PMG or Tufts gain. So while the non-recourse deduction itself can be extremely flexible, the partnership minimum gain or Tufts gain that comes in the future, and I'll explain when that event occurs or when it could occur, has to be strictly followed according to the rules. So you have to have that provision in there, and you have to have it in there correctly. Now recall that a qualified income offset is different because a qualified income offset deals with the alternate test when you do not anticipate a certain event and you can't have a partner go negative. So basically it offsets income from another partner to the partner that would go negative. And by doing that, it basically cures the issue. That's completely different from a partnership minimum gain. Partnership minimum gain basically says, okay, we're going to allow you to have flexibility, but you're going to have to follow our rules upon certain events. It's basically like you are selling yourself to the devil. You're saying, okay, I want the flexibility of having these non-recourse deductions today, but I guess I'll just have to follow the rules later on, which are extremely strict. You can't alter them. They have to be followed. If you do not follow them, all the deductions will be in the past will be considered will have to be they'll have to be reallocated based on partners' interest in the partnership, and that affects all partners, not just the partner that doesn't properly address. So it could create all sorts of liability, legal liability, lawsuits and whatnot brought. So you got to be careful. By the way, I mentioned the partner's interest in the partnership. If this safe harbor is not met, then we apply the partner's interest in the partnership, which is that factors test, which I talked about again in the first video. There is no safe harbor when it comes to partner's interest in the partnership for non-recourse deductions. There is a safe harbor, though, for the non-recourse deductions if you meet this. That's very important to understand. All right. So now, since we talked about the heart of the safe harbor is the partnership minimum gain provision. So let's talk about this minimum gain chargeback. And I already kind of talked about it. The idea is, remember in our example, right, we had the partnership that purchased the property for $1 million and it went down to $800,000. Well, we talked about how the Tufts gain is the difference between the basis and the actual mortgage. So the mortgage in our example was $1 million. That was a non-recourse mortgage, $1 million, right? The basis, let's say the basis in our example went down to $800,000. So I gave you the value went down to $800,000, right? So the fair market value is $800,000. Let's assume the adjusted basis is also $800,000. To calculate the partnership minimum gain or the Tufts gain, you subtract away from the mortgage amount from the basis. And the difference is the partnership minimum gain. The partnership minimum gain, the PMG. So minimum gain chargeback provision says again that you're allowed to have the flexibility of the non-recourse deductions for these partners. So again, the partnership owns the property under non-recourse terms. The partners can be allocated any way the partnership seems fit in the partnership agreement, as long as it's reasonably consistent, right? That's the idea, and you meet the alternate or basic test, which that shouldn't be too hard to meet. However, when there's a partnership minimum gain, the minimum gain chargeback is going to this provision is going to trigger gain to those partners in accordance with how much to their share of minimum gain, each partner's minimum share. So that's really what this provision is all about. So the minimum gain chargeback provision comes into effect when there is a net decrease. That's key. When there's a net decrease. So either the mortgage can go up or the adjusted basis can go down. That will create a net decrease in the partnership minimum gain. So partnership minimum gain for any specific time will be the mortgage minus the adjusted basis. If that number goes down, you have to recognize gain for the portion it decreases by. The portion decreases. And each partner will recognize his or her share of the net decrease in the minimum gain, which I'll explain how we calculate that. So the proper minimum gain chargeback provision in the partnership agreement must provide each partner must be allocated items of income and gain for that year at least equal to the partner's share of net decrease and minimum gain. So it's just the portion of the decrease. Just the portion of the decrease. That's it. All right. So here is partnership minimum gain, which I just talked about how you explain. So it's the non-recourse debt minus the book value or basis of the property. That's how we calculate minimum gain. The minimum gain increases for additional debt or decrease in property basis. Okay? So I apologize. I said that when I showed you the previous slide, how an increase in the mortgage or a decrease in adjusted basis will decrease. I meant that will increase. So remember, the gain is only triggered when the partnership minimum gain goes down. So when the partnership minimum gain goes down, the minimum gain chargeback provision is triggered when there's a decrease. Now there's a few exceptions. There's a few exceptions to that, and I'm going to talk about those briefly with you when we talk about other items. but that's really important. So partnership minimum gain is the gain realized that the partnership disposed of all property subject to non-recourse liabilities for consideration. Which, remember, the idea is that under Tufts, you have to include in the amount realized the full amount of that non-recourse debt. And that's how it creates that gain. Because if you're discharging property, you're giving up that property which has that basis, so the difference will be gain. So we talk about minimum gain will increase. An increase in minimum gain does not trigger gain. It increases the amount. But when it decreases later on, that's when it triggers you have to record the gain each partner. Because the idea is that you have to keep into account any changes. All right. So the next thing is the partner's share of a net decrease in partnership minimum gain. So now that we've looked at the partnership minimum gain and the minimum gain chargeback provision, remember that each partner has to recognize his or her share of partnership minimum gain. To calculate that, we first have to calculate the net decrease in the partnership minimum gain, the partner's share. So the net decrease in the partnership minimum gain, partner's share. Sorry, this is hard. This gets wordy. A partner's share of the net decrease in the partnership minimum gain equals the net decrease in the partnership minimum gain. So we're looking at the overall decrease in the PMG times this fraction. The partner's share of minimum gain at prior year end over the partnership minimum gain at year end. So you're basically getting that percentage. You're saying that is the portion that the partner is responsible for. Now we take that, and to calculate the partner's share of minimum gain for our calculation, it's the sum of any non-recourse deductions allocated to the partner plus distributions to the partner of non-recourse borrowing. So the idea here is we call these non-recourse distributions, NR distributions. And this is an interesting concept. Really, where you really see this is that a partnership sometimes will borrow. This is usually where this happens. A partnership borrows non-recourse funds. Non-recourse funds, just cash. And secures property the partnership has. Partnership property. And then the partnership distributes that cash to the partners. That amount is considered a non-recourse distribution to the partner. That increases the share of partnership minimum gain. Now we subtract away the partner's share of net decreases in partnership minimum gain, which we just talked about that. That was this formula. Partner's share of net decrease in partnership minimum gain. That is that formula. So see previous slide on how to calculate. The idea is that you don't take that into account because it's already been accounted for when you calculate the gain the partner has to record. Gain of partner. And you also subtract away the partner's share of decreases in partnership minimum gain from revaluations. Now, this is a more advanced topic. I'm not going to go into the revaluations, but this can create all sorts of headaches. Any revaluations. Okay. So, I know I mentioned earlier that non-recourse deductions, the main time when the simple way to know you have a non-recourse deduction, again, is when you have deductions that are attributable to non-recourse debt for property that are cost recovery deductions. And remember that you can't use substantial economic effect because the non-recourse debt exceeds the adjusted basis or book value. So any deduction that surpasses that amount, once it goes beyond that amount, once this amount becomes greater than zero, this amount, the non-recourse debt is greater than adjusted basis, then that's the simple way to know you have a non-recourse deduction. These are deductions resulting in an increase in partnership minimum gain. This is the long way to understand this. Because if you look at this, partnership minimum gain can come from not just non-recourse deductions, but also distributions. So you got to actually use this analysis, but this is usually, when you have cost recovery deductions, this is usually when you see it. But this is the real one. So non-recourse deductions are deductions resulting in an increase of partnership minimum gain that come from depreciation of property, resulting in book value less than NR debt, which is what we have here, and non-recourse borrowing in the partnership. That's what we just saw. whenever the partnership takes on more. But this can't be used as a distribution. So this is not a distribution. It's used for partnership expenses. If it's used for partnership expenses. So contrast this with the previous slide. We talked about what happens when the partnership borrows non-recourse fund. It secures partnership asset, right? And then distributes the cash to the partners. Instead of distributing cash to partners, the partnership uses that money to pay other, maybe buy other property or pay off some expenses in the partnership. That is the main difference. I know it gets very, very nuanced here. And the formula is the non-recourse deductions equal the increase in the partnership minimum gain minus distributions of non-recourse borrowing proceeds. So again, I strongly recommend looking at some examples. So here I forgot to put compare previous slide non-recourse distributions. So that's the key, is that last step. It's not distributed to the partners. It's actually paid out to the partnership for other expenses or to buy other assets. Now the last thing I want to talk about is some additional items. This is basically just the last part. After you read this, I strongly recommend you look at some examples, because this is an area where you definitely need to look at examples, because it can switch one year and then go back another year. It can be substantial economic effect in year 1, then NRD in year 2, SEE in year 3, go back and forth. It can do all sorts of things. Partners' interest in the partnership, sometimes I can make this so difficult. In real life, it can be so difficult. Okay, so I just want to talk about a few additional items with you, and then I want you to try to do some examples on your own. If you can't find, if you're not in my course, just go online, look at non-recourse deductions examples. You can just go online and look for that. But if you're in a course, just look at whatever the faculty member has recommended. Okay. So before I read through the specific items on this slide, I want to talk about how I mentioned that that partnership minimum gain, a decrease, is not triggered for certain events. So what I mean is there's certain times when the partnership minimum gain is decreased but does not trigger gain. Okay? And those include conversions and refinancing, contributions of capital, revaluations, waiver. So conversions and refinancing, that deals with, you have some type of conversion or refinancing with the actual non-recourse liability. If the partnership minimum gain goes down because of that, that should not trigger gain. Contributions of capital. So if a partner contributes more capital and that reduces the partnership minimum gain, that should also not trigger gain. These are just not appropriate times that Congress thinks. Revaluations. So I mentioned on a previous slide that revaluations can have some effect, but revaluations in general should not trigger partnership minimum gain when the partnership minimum gain goes down. Waiver, which that can be very, very, very specific, that in addition, it's not going to be triggering the partnership minimum gain when the partnership minimum gain goes down. All right. So a QIO is triggered whenever a deficit in a partner's capital account is created in excess of the amount that the partner is obligated to restore. That's what we've seen, and it's not anticipated, right? It's a non-anticipated. When you're looking at the alternate test, and you have like a limited partner that can't go negative or can't go beyond a certain negative amount, so you have to offset certain income. The idea, though, is that when a qualified income offset does that, and if a partnership minimum gain is affected and goes down because of a QIO adjustment, will that be triggered with respect to the partnership minimum gain? And the answer is no. A QIO does not. Let me write that down. A QIO is not triggered by the partnership minimum gain provision. And again, the best way to think about that example is it's possible that when you look at non-recourse deductions, the numbers for the limited partner can still go negative even beyond what the partner is expected to contribute. That's just how it happens, because remember, the lender is the one that actually bears the risk. This is just what happens. This happens, okay? Because the idea is that with the partnership minimum gain, if there's a minimum gain chargeback provision, when the property is disposed of in the future, remember, we have to follow the strict rules. So you get flexibility now, and you get to be able to have that negative capital account balance. So with non-recourse deductions, limited partners their capital accounts will go way below negative a lot of times, right? Go well below negative. Let's say we have a limited partner that is not expected to go negative, meaning that they're not expected to contribute anything beyond their investment. So they're limited to zero. We'll just say limited to $0 in capital. Well, NRDs, the capital accounts will go negative eventually if you don't get rid of the property. The idea is that that negative will be offset in the future by the minimum gain chargeback provision with respect to that partner, and that negative will offset and go to zero. That's the idea. However, when you look at the alternate test in the QIO is trying to keep that zero. How does that work? And the idea is that a QIO is not going to be triggered by the partnership minimum gain in that case. That's really important to understand. Okay? A lot of students have trouble understanding that. The best way to understand an example like that is look at examples with numbers. But remember, if you go back to the, I recommend looking at again, I know I said this now 8, 9 times, going back to the first video, the first topic, and you see how the QIO works. When it's not anticipated, it's possible that partner can go negative, but the partner can't go negative because, again, the partner is limited to zero. The limited partner is limited to zero. It's usually the case. So we give that limited partner certain income that from other partners that will get their capital balance back to zero or positive. So they don't run afoul of those rules. Well, NRDs is a completely separate animal. That can have negative capital account balances. That's fine. That's fine. Okay? So if there's a negative capital account balance because of NRD, the QIO doesn't come in and say, oh, because there's negative from the NRD, we have to offset and give all that money back. No, the idea is that the minimum gain chargeback operates independently in the future. And remember that in order for this to actually be respected and not subject to partners' interest in the partnership and the factors test, you have to follow the strict rules under the partnership agreement. All right, so the rest of the things here, I have additional items. Partners, non-recourse liability. You can read about that. This will be discussed more in a later video, not with respect to allocations, but how we allocate non-recourse liabilities. So this will be considered later on. But what you're going to see is that we have special rules for allocating non-recourse liabilities for each partner. This in itself, it can be tricky and one of the more challenging topics in partnership tax. So I recommend looking at that alone. Partner non-recourse debt minimum gain. This is the minimum gain attributable to the partner's non-recourse debt. Partners non-recourse deductions. So that's the non-recourse deductions attributable to each partner. And then required tax treatment. The partner's non-recourse deductions must be allocated to the partner bearing the risk of loss. And then a decrease in the partner non-recourse debt minimum gain must be allocated to the corresponding partner. This is the chargeback. So the idea here is that certain partners can't get other partners non-recourse deductions. And then again, following the strict rules, that partner that was allocated the non-recourse deductions must get that portion of gain when it comes to chargeback. All right, so this concludes our discussion of allocations that are related to non-recourse deductions. The next discussion will deal with allocations related to book tax disparity. I look forward to you watching that video and listening to that topic.